Yeah, hello everybody. This is my attempt to get rid of some additional ideas concerning international tax planning, and let's remember what it's all about. Tax planning can be roughly defined as attempts to lower the tax burden in comparison to another alternative situation which you would regard it as the normal or the starting situation. So you want to exchange one existing or expectable situation against another situation which probably is better concerning the tax consequences. So tax planning can either be finding chances or, what becomes more and more relevant in last years, avoiding risks in an international scale or area at least. Finding chances is the traditional field of tax planning, the ways to behave in a way that you or your client pays less taxes than otherwise. Avoiding risks is rather a developing new field of tax planning. I insist that you should take that into account. Here, you don't have to develop more favorable scenarios, but here you have to foresee what potentially your client is going to do and what is potentially dangerous. So, avoiding risks means have an eye on what people might do without asking you. So, very often in the international area, things have drastic consequences which, in a national surrounding, are completely natural and unproblematic. For example, from time to time, people set up a company or so. Um, No problem. Now, when somebody has done that already 2 or 3 times in Germany, probably that person comes to the idea to set up a company somewhere in Switzerland or in England or so without proper advice from a qualified tax advisor in advance. They just inform them afterwards, after everything has been negotiated and signed, which might be a total catastrophe. And so avoiding risks is important. Yeah, so we might make our definition a bit better. So tax planning is either lowering the tax burden in comparison to another alternative situation that would be using chances, or keeping the tax burden low in comparison to another potentially dangerous or more expensive alternative situation. Yeah, what is it all about? Naturally, you have to keep one necessary restriction in mind. Tax planning is absolutely not about minimizing the tax burden, but about maximizing the net result of the taxpayer. So, a third step for improving our definition would be not lowering the tax burden, but improving the net income or net result of the taxpayer by lowering the tax burden or keeping it low. Because minimizing the tax burden is very, very easy for all of us. You can minimize your consume taxes just by stopping to eat and drink and buy. And now you will immediately see that this is not a very reasonable behavior. It ends with your death. So it's not recommendable. Only if you can keep the same amount of wealth for you and then end up with paying lower taxes, that would be recommendable and favorable. The same with income tax. We all can avoid income tax. Just quit your job, burn your money, and begin to sleep under a bridge and live from a bottle of wine which you steal from time to time in a supermarket. Then you spend half of your life under a bridge and the other half sleeping in prison. Um, so, in a full meal pension run by the state or by a facility which is ordered to take care of you by the state, not recommendable, really not. So successful would only be an approach where your income stays considerably high, comparably high, but your tax goes down so that your net result goes up. So that's absolutely not the same thing like minimizing taxes. How can it be done? First, you need ideas. So either you need to find a way how you can change the taxpayer's behavior in a way that the overall tax burden goes down. So you look at what the taxpayer intends to do or does at the moment, and then create alternative scenarios where you have the idea they might lead to a same or a comparable economic outcome, but where the tax burden is lower so that the net result will be higher. The other alternative, that would be taking chances. The other alternative would be generate ideas how badly your taxpayer can behave. So what your taxpayer might do without asking you, or just do, which unwanted behavior, which risky behavior under a tax aspect might occur in order to be on your guard against things like these. That would be avoiding risks. By the way, that's far more difficult, and it would probably be dangerous to underline too much that you see that as a kind of your task. Legally, in any legal document or so, I would never underwrite this as a part of my job, because then you would be liable for any lack of imagination how idiotic your client could behave. But if you really care for your client, for example, if it's your firm also, then naturally you need to imagine things and be on your look. A tax advisor probably would never accept part number two as a part of his official job, but if you are the head of a tax department of a group, of a company or so, then it's naturally the job to imagine what your people could do which might damage the whole company under a tax aspect. So their tax planning is definitely also including the risk factor. Um, Naturally, a tax advisor from outside would probably refrain from task part number two, risks avoidance, because of the impossibility to take liability for that. You can never guarantee that you are able to take any liability for fulfillment, proper fulfillment of that task. Then, when you have ideas, you must form not only a vague idea of what comes out, you must absolutely precisely, as precise as it is possible, assess what comes out and then compare it with the previous situation. So you must calculate things. You must assess the legal situation of what is done at the moment. So that means when you have ever solved cases with application of the legal rules, this is exactly what you have to do in such a situation. Your starting situation has to be absolutely known to you, all the tax consequences in all countries involved, all the double taxation treaty rules which are applicable, everything which comes into play. So a full case solution must be on your mind with every detail. And then you must be able to precisely calculate the results. So when I earned 100,000 euro in Germany, then after the application of German, US, and Bermuda's tax law at the present situation, let's say 45,000 euro remain, full stop. Then, only then you can compare if the alternative situation is better. So a general feeling about the tax consequences of the situation, that does not really help. So when you ever are asked in an exam or somewhere else, what is that starting situation without a proper knowledge that you really can imagine things, what happen up to the details. The discussion is senseless. So just to say, I feel about, there will be interest paid, so that's interest a business expense. Well, then you already overlook that it will be a business revenue in the hands of the recipient, and so half of the ideas are already gone, and so you must follow up everything in every step of the events. Then you have to imagine your alternative scenario and then again assess all the legal consequences. It does not help just to say, then I think a certain thing will be different. You have to follow it up through all the steps and imagine what happens. So only then you can um, compare. And if you can't compare, you can't decide what is better. If you don't see everything what happens in the alternative scenario, you can also not assess risks. What if something goes wrong or so? What if you overlooked something? So if you can't properly calculate and imagine every detail of the two situations which you compare, then you have no possibility to decide. Then you can just feel about the situation. Well, and for feelings, nobody gives you a point in no exam and in no job interview all over the world, probably. Well, apart from the case where you are going to apply for a job as a tax advisor or a psychologist, perhaps they will appreciate your feelings, but they will give the job to somebody else, probably. Good. Now, the most and best way to learn is to learn from people who make things wrong. By the way, it's not a shame if one just does this important step on one's own. So, to start with making things wrong and then making things better, because nobody will ever have the best idea at the first moment. Probably you just begin to run and have an idea, walk into a direction, and then you hit a wall, which blocks the way, and then you say, oh my God, my idea went wrong. Well, you will probably not be the one and only person who finds the world's most excellent tax saving model, but when you know all the walls which can be hit, then at least you have an understanding of the things which do not work, and that gives you a more precise understanding of what must be done. Well, the first thing is you need to take into account everything which happens in all states of the world. So if you establish a GmbH in Germany, then you also have to waste the thought what might happen in the Federal Republic of Farawaystan, or what will be the consequences in the tax law of Nepal, if that is in any way connected to the situation. Can't ignore things. All tax consequences. So income tax, trade tax, corporation tax within Germany. People sometimes tend to die. So what happens when somebody dies concerning inheritance tax? If you set up a firm's structure and if your tax planning is not restricted to one single moment, then you have also to take that into account. Yeah. Then many states naturally have learned. So if there were very clever tax saving ideas, very often they have specific anti-tax saving rules. So you must know all these rules in all the states involved, because when you overlook something and you create a tax saving model where some state has an idea, has a special legislation which ruins all the positive effects, then you probably end up with a complicated situation which has some negative effects and where all the positive effects have been ruined by that special legislation. So you must have an overview about all that. So bad examples, what you can do wrong are many. Here's one. Imagine the following situation. Sole proprietor SP from the German town of Bad Pyrmont, that really exists, got an advice from a tax advisor, and now the tax advisor does not hide and beat about the bush about his own quality. He is in the city of Bad Advice, so of bad advice. That's a fictitious city, naturally. You see that from the asterisk at the beginning. Good. Our tax advisor says, establish a corporation in a low tax area, give it an enormous amount of capital, borrow that capital back in form of a loan, then pay interest to it for that credit. So you have a business expense in Germany, the interest, and your company abroad in the tax haven gets the interest revenue, and there it will be taxed at a very low rate. So German tax goes down, tax haven tax goes up a bit. Below the line, you save money. When you later bring back the money to Germany, it will be a dividend, and the dividend will be tax-free. I heard that from many holding companies in Germany. Repatriation of a dividend is tax-free. Now, let's think about everything which was going wrong here. The advice ignored the existence of an interest barrier. You know, you probably heard that in many states, especially due to the EU Anti-Tax Avoidance Directive, deducting interest as a business expense is limited to a certain amount if you have not very, very good reasons for paying interest. So the first thing would have been test if that interest barrier limits the deductibility of the interest payments which you propose to make. If so, you would have a taxable revenue still in the tax haven, but you would have no deductible business expense, or a part of it would be no deductible business expense in Germany, and that would spoil probably a bit of the effect. If the interest barrier does not apply, then we still have under trade tax law the obligation to add back a part of the interest. And so a part of the interest will be taxed not by German income tax or corporation tax, but by trade tax. And now if we have a sole proprietor, there is a surprise. Trade tax amounts will be credited to the income tax amount. So it might be that if you lower the income tax strongly, that then the trade tax can no longer be credited, so that in the end that might be an extra burden. Here it begins to become complicated, so we would have to take really a sheet of paper and begin to calculate what really happens and might happen. Naturally, you need to know how high is your corporation tax rate on the interest revenue in the state where you set up that corporation. You would have to ask yourself if there is a controlled foreign companies tax for the sole proprietor of that tax haven company in his or her home state. Indeed, here in Germany, we would apply a controlled foreign companies taxation on shareholders who have shares in a tax haven company. And that applies even before the dividends, the profits of that company are paid out to the shareholder. Immediately in the year when the interest revenue is paid over to our tax haven company, that profit of the tax haven company will end up or will lead to an additional tax, the CFC tax, or in German Hinzurechnungsbesteuerung tax, for the shareholder, and that additional tax goes up to the full personal interest rate, tax rate. So imagine our sole proprietor has a marginal rate of 45%, then if in the tax haven 1% is only paid, an additional tax of 44% would be due here in Germany on the sole reason of or that our shareholder has shares in a tax haven company which only pays 1%. So that could already be a problem. Then later, how high will the amounts be taxed when the interest is distributed as dividends? The initial information which our tax advisor, was it really a tax advisor? Hardly believable, gave is that the dividends would be tax-free, and he said, or she said, I know that from the example of many holding companies. Yes, 8B KSDG, but this is not applicable for natural persons. Natural persons pay either 60% tax on their dividends or pay 25% flat rate. So everything went wrong here, and so that's highly awkward, really awkward. This is not Harvard quality. This is awkward quality. And yeah, there is still something missing. Will there be any other states involved by levying the taxes? For example, what happens if the sole proprietor has a second residence somewhere and that second state also has a CFC legislation or claims some amount of the dividends or so? One never knows. So this is probably what we in Germany call a shot into the oven, complete catastrophe. So nothing. What can we learn from that? When you try to make a suggestion for a tax saving construction, you must properly make an exact inventory of all the potential tax consequences and on all levels in all countries. So you have to follow things on properly. I have very often seen in discussions with beginners that they limit themselves to the consequences in Germany. Well, and this is surprising, because if you buy a globe, then you see Germany is rather small. There are other parts of the world than Germany. By the way, that also happens to the non-German beginners. Seems to be an infectious disease when you come to a country that you forget that the rest of the world exists. So naturally, the important question is what happens here and what happens in the rest of the world. You can't ignore things in the rest of the world. If you look to international tax planning, by definition, that's cross-border things. And so there is always at least one other state in play, and probably more of them. Good. Yeah. A bad example again. How can you do things wrongly? Imagine you have a student and that student wants to analyze how a dividend is treated when the participation is held by a structure like the following one. So we have a GmbH in Germany. It pays a dividend. The dividend is gross 100,000, but withholding tax of 25,000 is taken, and you only get 75,000 to the bank. That dividend is now collected by a German holding company in the form of a GmbH and Co. KG. KG is a limited partnership, and a GmbH and Co. KG is a KG where the full partner is a juridical person and where one or several others are limited partners. They may be natural persons. So you have here a natural person as the limited partner, lives abroad, and you have German GmbH 2, and that is active as a full partner of the GmbH and Co. KG. And the natural person, the limited partner, gets 100% share in the profit. And surprise, the GmbH, which does the full partner and takes the liability, has 0% in the profit. That is not perfectly feasible, you have to give the GmbH to a small amount of the profit or a fixed amount because it takes the risk. Otherwise, that would not be accepted as some deal as between unrelated parties. But in principle, that is a very traditional model in Germany, that the GmbH gets nearly no profit share and the limited partner natural person gets everything. So you combine the limitation of liability, which is the sign or the characteristic of a juridical person, with the fact that income tax and not corporation tax is paid. Now, what could be the sense behind it? A student, a beginner, or a disorientated expert does perhaps quick time thinking and thinks dividend is tax-free at the level of the GmbH and Co. KG because of 8b KSDG. Shifting the money from the KG to the natural person would be a dividend too. Then you don't think about how the dividend is taxed in Germany at the level of the KG, and perhaps you do not think about the question if the home state of the natural person taxes the KG profit under exemption method or the credit method. But that makes a big, big difference. If the dividend amount arriving at the KG level is treated by the natural person's home state under the exemption method, then there will be no foreign tax apart from the German tax on the KG level on the dividend income. If the credit method would be applied, then everything would be completely different. Then you would have the German tax and the foreign tax, and the higher tax level would count. So a tax saving model would probably be something different. So here somebody has made everything different. I have seen that some time ago in an exam case with a beginner. So how could one have avoided mistakes like these? The answer is look at the situation and then follow up everything which happens. By the way, if you have a situation and you do not completely understand what happens, at least make that clear during the discussion. Otherwise, one thinks it's your fault. If data is missing, you must clearly say which information you are missing. Okay, in real life, then you have to obtain it by taking a telephone receiver and making a call to the people who know and ask them. Good, let's begin. The first step would be there is a GmbH at the bottom there, the money is earned. So the first step would be what does the GmbH have to pay for its profit in Germany and perhaps in other states? They might have a PE somewhere else. It might be that they get money from somewhere else you do not know, and up to now you have not checked. But if we are sure what it pays and that there is nothing else, we can go to the next level, the GmbH and Co. KG. There the money arrives in the next step of the events. And so the question would be, how is the dividend taxed at that level? In Germany, with income tax, straight tax, every other tax which you can imagine, and then in the state of the natural person, perhaps. Later, the money is paid out to the natural person. Are there tax consequences from transferring the money to the natural person? Now, this above here, the GmbH and Co. KG, is, under the German perspective, a partnership. And taking out cash from a partnership is the withdrawal of cash, and that usually has no tax consequences. It's not income again. It's just a transfer of money. So that would be without immediate consequences. It might be what you know or should know, that this partnership might be seen by the home state of the natural person has a different kind of thing. So if they see it as a company, might happen. Then paying out money from a company to the natural person would be, from their perspective, a dividend. That would be income. Now, if you can establish or ascertain that the home state of the natural person also says that withdrawal of money is a withdrawal and has no tax consequences, then our consequences of the construction would be the dividend ends up in the hands of the KG. So the withholding tax will be credited and repaid to the KG. So you have again 100,000 euro at the end of the year, 75,000 in cash and 25,000 which are credited to you by the fiscal office. Then that will be replaced by the tax rate of that natural person. And as a GmbH and Co. KG in all probability has income from business because it has a PE here, then 60% will be taxable only under 3 number 40. That would be 60,000, and the tax rate of the natural person, well, that might now be 35%, 40%, 45%, one does not know, and depending on what you calculate, it might be 24% of the 100,000, or if it's 45%, then you would probably have 45% applied to 60%. That is, oh my God, probably something like 27%. Would even be more than the 25 withholding tax. But the alternative would perhaps have been that the dividend is directly paid over to the home state of that natural person. And if it were directly paid to the home state of that natural person, you would have the dividend taxed in the home state of the natural person. And if their income tax is higher than 27%, then this nice deviation here about by using the GmbH and Co. KG might make some sense. Imagine at home the dividend would be taxed with 50%, then the GmbH and Co. KG would you save half of the money. But the decisive thing is first to find out everything what happens. And as you see, I just created an alternative situation for comparison. The natural idea would have been that the GmbH1 is directly held by the natural person. Then a dividend would be paid out from Germany under the double taxation treaty. Germany would be allowed to keep 15% of the dividend. That would be credited in the home state. So the 15% would play no big role because they are refunded by the credit virtually. But it might be that the personal income tax rate of that natural person in his or her state abroad is far higher than the rates which you could obtain if you term the things taxable within Germany. And then you could understand these things. Okay, so to make it right, find out systematically all tax consequences whenever you are confronted with an international tax planning task. Look on every potential level. Quick conclusions are not possible. You just ruin your reputation if you do not follow in a systematic way all the steps. That is, by the way, the reason, even if you get a very simple question, usually you get some 10 minutes or 5 minutes or so to answer that simple question, because you need to assess all the consequences of a simple situation in all the states of the earth. Naturally, when it comes to an exam situation or so, you are only trained in, let's say, German law and double taxation treaties. Perhaps not an expert in US law or the law of Far Eastern or what else, then you must be given the additional information what happens or what is expected to happen in the other states. Clear. In reality, naturally, you never are perfect. If you have an idea, in reality, and naturally, you would obtain that missing information about what happens in the other state by taking a telephone receiver. Calling a colleague in the other state and asking him or her what is going to happen there. Then you put down the telephone receiver, pay an enormous invoice because it will cost money, and then, ladies and gentlemen, you will do something really surprising. You will take a telephone receiver again and call another tax advisor in the other state and tell the whole story again and look for deviations in the information what you get, because it might be that somebody has got you wrong, has overlooked some aspect, and so you got the wrong information. So you probably try to be on the safe side under all circumstances, because international tax planning ideas usually are about much money, not trifles. Good. So, to sum up potential mistakes, the list of mistakes is far from complete, you know. Mistakes is the one thing where inventions are made from year to year, and they are always surprising. And most of them, you know, if you know me, many of them have been invented by me myself. So I always also find some nice mistakes by just making them, and then you get better in the course of time. At least one can hope so. You can make mistakes in the basics. So making mistakes like the ones I inserted into the case just now, applying 8B KSTG to a taxpayer who is not subject to KSTG but to ESTG. That's really, really awkward. That's a big shot into the oven. That's really pain for people listening to you. So try to avoid that. So be slow, be critical, be exact. Don't get nervous. If you say something like this, basics mistakes is always, it's really bad. Makes your whole assessment of a situation usually rubbish. Bad. You can overlook steps or states which are involved in a step of the sequence of events. Okay, still bad. If you didn't think about the transfer of the money to the natural person, then you left out a bit of the situation, you ignored a bit of the risks. If you, for example, didn't think about the taxation of the KG profit in the home state of the natural person, if that were credit method, then the whole thing would have been spoiled. Very bad still, but not so bad as a mistake in the fundamental basics. And you can also overlook some special anti-tax saving legislation in at least one of the states involved, and your whole model is useless again. At least that is rather an expert level mistake, because then you just overlooked something and didn't actively tell the people rubbish and wrong things. Naturally, the best thing is to try to avoid all that. Good. When it comes to overlooking anti-tax saving measures, let's make a small inventory about what we have. We have three categories of tax saving models: the legal ones, the illegal ones, and the ones in between, potentially tax abusive things. You remember from the beginners lectures, tax abuse, well, would be the German term, and is probably also frequent in other states. That's not really illegal tax evasion. It's something different. The clearly legal models just apply the existing rules in a favorable way. Probably nobody has ever thought about that favorable way, that it is possible. So it's probably a bad surprise for the fiscal office, but everything is clear. Situation has been properly disclosed. There is no debate about what you did. So green light. The illegal models work by hiding information because, tax fraud. That's also in the countries where tax evasion is defined in a broader way. That's always the core of the thing. Hiding information, lying about what you do, that's the other extreme. And the thing in the middle is abuse usually works by transactions which formally are something different than what triggers the tax, but where the economic reality is exactly what the law describes as taxable behavior. You probably remember my very simple-minded example for the beginners that I don't sell you a book for 10 euro, but I make you a gift. I give you that book for free under the condition that you give me a present of 10 euro. So the formal construction is something different, like a sale. But if you assess the economic reality, what I did was exactly a sale. So that would be tax abuse. Um, you do something complicated, and if you look through what is really done, this is exactly, if you leave the formalities aside, this is exactly what is described in the law and should be taxable. Now, naturally, states don't like tax saving constructions, so they have countermeasures against these things, and depending on the situation, they are different. The legal ones, you can do nothing against them, but what you can do is if the law grants somebody a tax advantage which you don't like, you can change the law, and not retroactively, but at least for the future, and very often that has already been done. You can create additional rules which destroy the financial advantage from that favorable behavior. When it comes to the illegal models, their additional legal claims make no sense, because if somebody is already lying and willing to behave in a criminal way, it makes no sense to forbid more. For example, if somebody runs around and shoots people with a gun, usually these people cannot be impressed by also forbidding to have a gun, um, because if I'm willing to kill other people, it makes no difference if you also do not allow me to use a gun for that purpose. I have already decided to become a criminal. So if your tax saving ideas work by illegal means, hiding or deceiving, then the countermeasure, the appropriate one and the only appropriate one, would be improvement of control. Improve the ways to find out what happens, what the taxpayer doesn't tell you. And the things in between, tax abuse. Well, that works by, or that might work by somebody who tells you the complete truth what he or she does, but now our tax assessor, our tax inspector, does not really understand what's really going on. So you might be distracted by all the formalities, so that you do not understand that the whole complex series of events does basically mean something else economically, something far more simple. Now, when you have a national situation, for example, in Germany, it is not yet necessary to care about that much, because here a tax inspector or a tax official at the authorities knows about the German law, and so if you do something strange, then they think about what would be the natural alternative. They can compare what the real tax outcome should be, and they can then say, okay, this is a kind of tax abusive behavior. You just circumvene the straightforward way to do it, and you do that complicated construction to achieve a certain tax saving effect. And we We don't give you that. We tax you according to what you economically did. When you have a cross-border situation, the problem is that somebody in Germany probably does not have the full overview and cannot have the full overview about what is really happening and what the tax effects in all the different states are. And so probably you need additional facts about the tax situation in another state in order to be able to find out what the whole thing wants to achieve. So the appropriate countermeasure here is probably not specific legislation, because that is on the left way. Here the effect would be I designate or I design a behavior where my tax inspector at the fiscal office does not look through, or where he or she does not really understand that economically that's not different from something else, from some simple other behavior. And so transparency is that what you need here. And so here, in order to make abusive behavior impossible, the fiscal authorities need information on what's going on. So what are the tax consequences of the whole construction, and that it works together. So as anti-tax saving measures you find in the legal area, CFC legislation, limitation of benefits clauses in double taxation treaties, which say if you set up a company in a foreign country for which there is no real reason just to save taxes, then the treaty is not applicable to everything or certain things which that construction does. You establish an exit taxation and all that, many specific rules for specific situations which adjust the consequences to what the legislator really regards as appropriate. When it comes to improvement of control, you have probably heard during last decades there is more and more cross-border cooperation of the fiscal authorities. Exchange of information is more and more automatic